Hey everyone, Qualcomm stock has been on a nice rally to end 2023 and start 2024, which has a lot of investors asking if it's too late to buy Qualcomm stock. Well, in this video, I'll evaluate Qualcomm, its prospects, its longer term trajectory, its prospects for the next 2 years, weigh that all against its valuation and answer if I think Qualcomm stock is a buy for 2024 or if it's too late to buy this stock and investors would rather wait for a dip. So I'll answer those questions in this video. Let's jump right into it.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So I mentioned that Qualcomm stock has been on a nice little rally here. You could see jumping from around $100 per share up to $154 per share, but it's still down from its peak value of around $170 per share reached in late 2022 or late 2021, early 2022. Investors are hoping it can bounce back to that level and rise above that eventually. Now, revenue has come down a bit, but its prospects for the next couple of years in revenue look solid. 36.29 billion in revenue in the trailing 12 months. And as smartphones are being integrated with more powerful chips, more higher quantity of chips due to the rising effectiveness of AI and trying to bring more AI to mobile phones, especially with Samsung. Samsung has some cool features in their latest mobile phones, and that's all been benefiting Qualcomm, and that might continue to benefit Qualcomm going forward as the rate of innovation increases in smartphones. Then perhaps the upgrade cycle will shorten, right? Right now, people typically upgrade their smartphones every few years, maybe every 3 to 5 years. If the development, the innovation increases, the speed of innovation increases, your cell phone might feel obsolete after 2 years. And so that upgrade cycle may shorten, which will be good news for Qualcomm. The replacement cycle is really the key for Qualcomm because the cell phone, the handset industry is pretty mature. Its growth prospects are in the replacement cycle and in automotive. That segment for Qualcomm is growing very nicely as cars are being infused with more technology. So that's going to be good news for Qualcomm as well. Still, I don't want investors to think this is going to be a fast growing company. That's not the case. It's not going to grow very quickly. It's a less than double digit grower longer term. Operating profitability has been solid, although it has also been volatile. 21.94% in its latest trailing 12-month period. A operating profit margin over 20% is really good. If Qualcomm can maintain that or even build on that, that would be really good news. We just don't want to see big dips like before where Qualcomm keeps coming down. That's not expected to be the case. Let me show you its prospects for the next few years. So looking at earnings per share and revenue growth for the next few years, Qualcomm is expected to grow revenue by 6.3% in its fiscal year 2024, which ends in September, and 15.6% in earnings growth. So very solid earnings growth in 2024. Then in 2025, Qualcomm is expected to accelerate revenue growth to 8.5%, with earnings per share growth coming down to 10%. And then revenue growth of 5% in fiscal year 26 with earnings per share growth of 5%. So one thing that stands out is a decelerating earnings per share growth rate from 15.6 down to 10 down to 5, and then revenue growth of, let's say, mid-single digits of between 6 to 8% over the next few years. Solid to be sure, but not explosive growth, right? I mentioned that you can't expect explosive growth from Qualcomm, but I think investors looking at Qualcomm are not looking at a explosive growth stock. I think they're looking at a value stock, one that offers a good value versus the price that you're paying for it, which we'll look at towards the end of the video. So I want you to understand the importance of cash flow from operations. Cash flow from operations is one of the most vital metrics I consider when making an investment decision. If any financial shenanigans are happening, looking at this metric can help uncover the fraud. Moreover, looking at profitability without considering cash flow from operations can lead to a misleading picture of a company's performance. For instance, look at the example I have created here. The company reported a net loss of $250. However, When you look at the cash flow from operations, it was a gain of $35. How can that be? Well, two expenses a company must report on the income statement are depreciation and stock-based compensation. Importantly, these are non-cash expenses. Money is not leaving the company for these expenses. In the case of depreciation, when a company buys a machine for $750, it pays all of that price up front. However, generally accepted accounting principles require that the company take the expense over a period the machine is expected to operate. So if the machine is expected to last for 10 years, the annual expense will be $75 per year for 10 years, even though the company paid the $750 cash at the time of the purchase. Also, when a company offers its employees a stock option, it's not parting with cash. However, it must record the cash value of the option as an expense on the income statement. So moving on to the working capital items, inventory management is the easiest way a company can increase cash flow. The simplest case is when a business has 100 inventory units, sells 30 units, and doesn't replace those units. The decision would reduce total inventory and increase cash flow. As you might already be thinking, this isn't sustainable. Eventually, the company will deplete all its inventory and go out of business. Accounts payable is the money that a company owes another company and has not paid yet. And accounts receivable is the opposite. A company can increase its cash flow by collecting payments faster and paying suppliers slower. If done with skill, companies at scale can take advantage of these timing differences to boost cash flow by a couple of percent annually. Costco is one example that employs this strategy masterfully. Overall, if you observe cash flow increasing unsustainably, you should expect a reversal of that trend. The other big risk to consider is if you see a company reporting substantial profits but negative or weak cash flow due to rising accounts receivable. All right, so now that you have an idea of that, you can see Qualcomm at 30.73% offers a solid CFO to sales rate. The company is good at turning sales into cash flow from operations, and that's really good news, especially when you're looking at a company that's not growing very quickly. You at least want to see this company is generating strong profitability, strong cash flow from operations, which Qualcomm is certainly demonstrating here. And finally, I'll look at valuation. Qualcomm is trading at a forward price to earnings of 14.54, which is about the average this stock has traded for according to this metric. If we go back to 2021, you'll notice sometimes it was below this price range, right? Some moments it was below this price range, but there were also moments where it was above this price range, right? So 14.54 is right about the midpoint of this stock's valuation going back the last few years. And I would argue that its prospects over the next few years are better than they were at any point in the last few years. So investors have that going for them. Also, at a valuation of 14.54, it's trading at less than the earnings per share growth rate expected in 2024. You're expecting 15.6% according to Wall Street estimates. So I like when the stock's PE is below the earnings per share growth rate estimate going forward. That's one metric I look at when trying to evaluate the value of a stock, when trying to evaluate if it's expensive or not. So being below that rate tells me that it's a good value. Being at its average over the last 5 years also tells me that it's not too expensive. And then I like its prospects going forward given the increase in innovation in the handset market. So overall, I would say it's not too late to buy Qualcomm stock. I would say the stock is a reasonable stock to buy right now. Thank you for watching this video. I truly appreciate it. I know there's a lot you could be doing with your time and a lot of other videos you could be watching. So I truly appreciate that you chose to watch this one. If you want to see more videos just like this, hit the subscribe or the like button. They'll both help me make more videos just like this one. Thank you again.